Wall Street just finished an incredible week. The S&P 500 closed at a brand new all-time high. The Nasdaq jumped approximately 5%. Even the Russell 2000, which tracks smaller U.S. companies, climbed 3.5%. Investors were suddenly very optimistic. But underneath that rally, there is a disconnect. Stocks are climbing while the labor market weakens. In July, employers unexpectedly cut 23,000 jobs, pushing unemployment to 4.1%. Normally, fewer jobs mean less spending, which lowers corporate profits and drags stock prices down. Yet investors looked at that weak employment data and decided to buy stocks anyway. They ignored the immediate health of the labor market because they were watching something else entirely. Right now, Wall Street is not trading based on the day-to-day reality of the American economy. They are reacting to the lever that controls the flow of money, interest rates, and the Federal Reserve that sets them. Investors know the Federal Reserve has a difficult balancing act. It has to manage employment, economic growth, and inflation all at once. When the market reacts to job numbers, traders are really just trying to predict exactly what the Fed will do next with those interest rates. This diagram shows the inverse logic driving the market right now. When the labor market starts showing weakness and losing jobs, it signals that the broader economy is cooling off. A cooling economy gives the Fed more room to wait or even lower rates to keep things stable. And when rates go down, stocks look a lot more attractive. Stock prices don't exist in a vacuum. They constantly compete for your investment dollars against other assets, primarily government bonds. This dynamic played out clearly last week. As job growth stalled, the yield on the 10-year Treasury note dropped down to around 4.64%. When these ultra-safe government investments start paying less, investors are far more willing to take on the risk of buying stocks to get a better return. So a negative jobs report effectively becomes a positive signal for investors. Bad economic news tells Wall Street that cheaper money is likely on the horizon. But while traders celebrate the prospect of cheaper money, that same economic data tells a very different story outside of financial markets. Economists call this a divided or two-speed economy. Some Americans are thriving right now. If you hold significant stock assets or work in tech, your financial picture looks bright. But many other households are dealing with a tougher reality, higher daily living costs and a sudden chill in the job market. Consumer spending is a massive engine for the U.S. economy. If households become cautious because they are worried about their jobs, they buy less. Eventually, businesses feel that drop in sales. They stop hiring, which affects income, which reduces spending even further. Wall Street is betting that the Fed can lower rates before this cycle accelerates. But if the labor market actually breaks, corporate earnings will inevitably drop, and those record-high stock valuations won't hold up. There is one variable that could wreck the market's expectation for rate cuts: inflation. Next week, investors get the July Consumer Price Index, or CPI, which tracks what everyday buyers pay for things like groceries. That's followed by the Producer Price Index, measuring what businesses pay. These reports will show if prices are actually cooling down. Here is the nightmare scenario for the market. Inflation comes in hotter than expected. The Fed looks at the high prices and decides interest rates need to stay high for longer, despite the job losses. Treasury yields would rise again, putting immediate downward pressure on stock prices. This matrix shows the alternative. If inflation cools down, moving to the cold side of the chart, but consumer spending stays strong, you get a soft landing. That is the exact combination Wall Street needs to justify pushing the market even higher. People often see stocks hit record highs and assume it guarantees smooth sailing ahead. Or they panic, assuming a crash is mathematically overdue. Neither is inherently true. A high number on the S&P 500 is simply a reflection of current expectations. Investors are bidding up stocks today based on what they think the economy will be tomorrow. The upcoming inflation data will prove whether those rate cuts are actually coming, or if Wall Street is simply trading on a mirage.